What is going on, guys? In this video, we're going to be talking about what the best investing strategy is. Now, there are three very popular investing strategies. There's dollar cost averaging, there's lump sum investing, and there's buying the dip. You can see right here, 172 votes. 63% of you think dollar cost averaging is the best strategy, at least out of these three. And we're talking about long-term investing, not your day trading or any of that stuff. Now, you hear it from a lot of professionals, a lot of YouTubers. They all say the same thing, dollar cost average, right? But what if this isn't the best answer? I'll tell you right now, buying the dip is not the best answer. I actually did a video on that to prove that dollar cost averaging is better than buying the dip in the long run. But what about lump sum investing? Only 11% of you think that it is the better of the three. Again, 63% think it's dollar cost averaging. What if I were to tell you 63% of you are wrong? Well, 63% plus 26%. So 89% of you missed this question. I'm going to show you exactly why in this video. But before that, guys, check out my channel if you haven't already. I got over 100 videos teaching you about investing in the stock market. Subscribe if you haven't. Like this video and drop the comments below to help boost my algo. But let's dive in. So we got the two. We got lump sum investing and we have dollar cost averaging. So for the lump sum, let's say you got $240,000, whether that's from the lottery or it's from an inheritance, or you just withdrew all of your earnings from a really risky bet, stock, crypto, whatever it might be. You have $240,000 and you now want to put that into something safe like the S&P 500. Do you just drop that all in, or do dollar cost average, where every month you put in an equal amount, say $10,000, over the course of 24 months? Which one is the better option? Again, most of you think this is the better option, but I'm going to tell you right now, it is not. It is this, believe it or not. And right here of Dollar and Data, my boy Nick wrote an article called The Cost of Waiting, explaining this and why dollar cost averaging is not the best thing to do. This one sentence right here is what really pulled me into his article. Earlier this year, I wrote a piece illustrating how it is almost always optimal to invest a large sum of money right away rather than averaging in over time. Sitting in cash or even T-bills simply does not pay compared to markets, because most markets have long-term positive uptrends. That's what we see here, a nice, beautiful, positive uptrend. Even though we had the coronavirus crash, doesn't matter. Overall, there's a positive uptrend, and you know what they always say, early and often. You want to invest as early as possible. So that also goes for the short term. When we're talking about a 24-month period, throw that money in. Now you can see his article was published in 2019, September 2019, so right before the coronavirus. But check out his Twitter page. He's got almost 100,000 followers, got some really great articles. But let's dive into his article really quick, because he's got some pretty cool charts. So we're not going to read it all, but he's comparing, okay, you drop 240,000, or in his article, 2.4 million, in all at once and let it grow compared to dollar cost averaging like this. But then he also says, let's look at more conservative bets as well. What if we're not throwing 100% into the stock market? What if we're only doing 80-20? So 80% in stocks, 20% in bonds. And he also goes on to show 60-40. And pretty much every single time he tests a different ratio, this always beats dollar cost averaging into an all stock portfolio over 24 months. If we scroll down again, guys, check this out. A link will be below for you to read it. But here's his first chart. Very interesting to look at. And this is showing dollar cost averaging underperforms lump sum. Dollar cost averaging outperforms lump sum. If it's above the line, it's outperforming. If it's below the line, it's underperforming. And the mass majority is below the line. So that's something that you guys may want to, I just want to make sure you're clear. It's not like this will work 100% of the time, right? If you invested at the top of 2007, right before the housing market crash, That's probably not going to be as good as dollar cost averaging because we had such a huge bear market. But you need to look at averages and probability or statistics wise. You could see over the course of over 50 years, from 1960 all the way to 2018, the mass majority of the time, lump sum investing played out better. And this chart right here is comparing a 60-40. So you lump sum 60-40 compared to dollar cost averaging 100% into stocks. And if we scroll down, then he shows this chart right here. So you can see this is how many times on a bell curve that lump sum is better. And this is how many times dollar cost averaging is better. Obviously, lump sum is the better bet. And if we keep scrolling down, he has a nice little dynamic chart that shows you all the difference. And the craziest part is even an all bond allocation is still on average better than dollar cost averaging. So you're better off if you have a lump sum of $240,000, 2.4 million, whatever it is, just throw it all into bonds and you will perform better on average than if you dollar cost average into the stock market over the course of 24 months. That blew my mind. That's absolutely crazy. And if we scroll down, you can see right here, here's your dollar cost average versus the all bond lump sum. And the lump sum outperforms dollar cost average by almost 1% on average and in nearly half of all 24-month buying windows. I think that's wild. No one would think, I at least wouldn't think, that you're better off lump summing into all bonds compared to dollar cost averaging into the stock market. You can see also down here, this explains a little better. Dollar cost average over 24 months underperforms lump sum by 0.9% and underperforms lump sum in 49.4% of all months shown. So it's very cool, but I want to test this out myself. So we're going to jump over to an investment calculator, and I actually have two open. So you can see on the left, we have your starting amount, which is $0. Over 2 years, you will put $10,000 in. You're going to contribute $10,000 in at the beginning of each month, 10% rate of return. And then on your right, we have your lump sum of all $240,000 over 2 years, 10%, not adding another dollar in ever since. So just so we're clear, graphically, we're about to test out this compared to this. If this was a 10% return, doesn't matter if it's 10% return, 20%, 30%, as long as we're comparing apples to apples and not apples to oranges. All right, so we're going to click calculate, and this is for our dollar cost averaging side. And let's scroll down, and you can see right here, by dollar cost averaging $10,000 a month over 24 months, our ending balance is $265,000. We have a total interest or a total appreciation of $25,000. Okay, great. Now let's try the lump sum. Hit calculate, scroll down, $290,000. We now have total interest or total appreciation of $50,000. We did almost twice as better by just doing a lump sum compared to dollar cost averaging. And just to show you that it does not matter, let's do 30%. It doesn't matter as long as the two are the same. Calculate and calculate. And then you could see, even with a 30% return, the lump sum is still outperforming compared to the dollar cost average. Now it's even more wild. Let's do 10%, and then let's say we're more conservative and we're only getting, say, 6%. Let's calculate and calculate. Scroll down. Look at this. So even a more conservative bet, if you lump sum over the 24-month period, you're still outperforming the more aggressive with the higher rate of return for dollar cost averaging. So right there, that proves that 89% of you got this question wrong, but one person actually commented, and you could pause this video and read his description. This was right on the nail. He got this right. So props to you. That is the right answer right there. But yeah, I mean, after reading this article and then actually testing it out for myself, this absolutely blew me away because when I started investing, which was back in 2017, right around, ironically enough, right around this time, I had a decent amount of money saved away. And I decided, do I throw it all in or do I dollar cost average? And then the coronavirus happened and the market plummeted. And as it was dropping, I was like, ooh, let me start buying some. And then it bottomed out and maybe it was starting to go up. And I thought, do I just throw it all in or do I dollar cost average? This was unfortunately before I read Nick's article. And I decided to dollar cost average for most of the ride all the way up. And then I look back and I think, man, if I just threw it all in back here, or even if I threw it in at the top of coronavirus, and I would have had a nice average price of $335 when the market was down here, that would have been beautiful. I would have made so much more money, but I didn't. I dollar cost averaged that money in. Now, this doesn't mean you lump sum and you never invest again. This just means if you have a decent amount of money on hand, whether it be an inheritance, lottery, you name it, or you want to start investing and you have a decent amount of money, even if it's $10,000, you said, all right, time for me to start investing in the stock market. What do I do? Do I dollar cost average over maybe the course of a year, 2 years, 3 years? Or do I just take everything I have and throw it into the market? On average, your better bet, and here's the article again, you could go and read it. On average, you're better off just throwing your money in at the very beginning. And then as you make more money through your job or business, yes, you will add to it and by default, you will be dollar cost averaging. But again, we're talking about that initial amount of money. What do you do with it? Throw it in. Now, this isn't financial advice. I'm just showing you the raw numbers here and the facts and data that we have laid out. Obviously, if you throw in a bunch of money at the top of a crash, that emotionally may not feel well, right? It may be the economically right idea and statistically the right idea, but a lot of people can't overcome their emotions and it's too hard for them, and I get that. But again, this is just laying out the numbers here and on average. So on average doesn't mean it will work 100% of the time, but the odds are in your favor. But guys, let me know what you thought about this video. Did you know that dollar cost averaging wasn't the better of the two and that lump sum investing is actually the better option? If so, drop those comments below. Again, let me know about this video. If you liked it, give that thumbs up. Check out my other videos. And guys, as always, I will see you in the next one.